member, my good friend Mr. Murli and Mr. Dhanapal, the dignitaries on the dais, off the dais, members of the chamber, and professional friends. This topic assumes a significance for two special reasons. The first reason is this is the way in which the Ministry of Corporate Affairs is trying to address the grievances of small companies as well as unlisted companies. That's the first thing which we have to see. Because under the Companies Act 2013, they have not made any differentiation between a listed company and unlisted company, especially small private limited companies. They have made everything at par. That's the first thing which they are trying to address with this amendment bill. The second reason why it is very important is some of the procedural issues even bigger companies have handled. They are trying to address this. So to this extent, I believe the proposals which has been given by the Company Law Committee and how it has been taken into the amendment bill may be of worth discussing to all of you here. So the Company Law Committee, as you are aware, it has been formed in June 2015 with a 10 members committee to give recommendations on what are all the amendments which is required to be considered to ease the problems of corporates, as well as how the professionals can actually do a better service for the corporates. And interestingly, more than 2,000 recommendations have come. More than 2,000 recommendations have come from various walks of life, professionals as well as from industry, for requiring a lot of amendments in this. And a final report has been issued in February 2016. And based on that report, the amendment bill has been introduced in Lok Sabha in March 2016. If you look into the amendment, this amendment touches on sections of the Act as well as the related rules. To put it in simple terms, it will result in more than 100 amendments in the law and more than 50 amendments with respect to the related rules. So what we will do is we will just look at some of the major amendments within the given point of time. The first interesting point which you may be aware that the Companies Act 2013 has made mandatory that all companies should have the uniform accounting year, March as the accounting period. And they have only given some exemption in case if this is a subsidiary of a foreign company. And the foreign company requires mandatorily to prepare an accounting for consolidation purposes at a different accounting period. Say for example, calendar year in US, and there is an Indian company which is a subsidiary of a US company, then you can apply for an exemption to maintain your accounting books also for the calendar year. But at the same time, this exemption was not extended to investment below 51% but above 20%, which we call it as an associate entity. That creates a lot of hardship for companies, because many times we have seen that a small company which is an associate company of a foreign company has to maintain its books of accounts for group reporting for December, and again they have to close their accounts for March for the purposes of reporting to our regulatory body, which is the Registrar of Companies. Now this amendment bill proposes to give the exemption even for an associate of a foreign company, and it has to be applied and you can get that exemption. And another important point, you may be aware that the definition of subsidiary under the Companies Act 2013, even though it requires, if a company has its subsidiary companies or associate companies or joint venture companies, a consolidated financial statement has to be prepared according to the accounting standards. The definition of subsidiary which is given in the accounting standards vis-a-vis what is the definition given for a subsidiary in the Companies Act 2013 are divergent. Because in Companies Act 2013, the basis of determining whether a relationship of an investment in another company is a subsidiary is based on the total share capital. So when we are using the word total share capital, both the investment in the equity capital as well as the convertible preference shares are taken together, and if there is more than 51% of investment made by one company to another company on the total share capital, the other company is considered as a subsidiary company. Interestingly, we did an analysis of a group when we are advising them on the Ind AS conversion. There's an IFRS converged Indian accounting standard, and we were analyzing the investments made by that company. They have made some 27 investments in other companies, and according to the assessment made by the company, out of these 27 companies, 25 companies they are believing that it's not a subsidiary company. It's only because their investment is less than 51%. But when we analyzed according to the definition given in Companies Act 2013, we concluded that out of the 27 companies, 23 companies has to be considered as a subsidiary company. Only 4 companies will be considered as an associate company. The impact of that conclusion is that every balance sheet of the 23 companies has to be added line by line into the balance sheet of the parent company. It is a very big hardship. Now they have tried to make an alignment with the accounting standard by saying that we will not go by the concept of total share capital, but we will go by what is given in the accounting standard, voting power. So voting power, the moment I am using the word voting power, it restricted to equity share capital, and on that basis we will actually look into that. They are using the word total voting power, but it will not make any difference in the process. And that is an important change. And because of that, the compliance cost for many companies when they are preparing consolidated financial statement will come down drastically. And an interesting point for companies who are trying to retain talents, when the government is also talking about Skill India and Make in India and other initiatives, one of the aspects which companies are looking for is how the company can retain talents. Normally we talk about employee stock option plans or sweat equity plans. And in sweat equity plan, one of the conditions which is there in Companies Act 2013 is a company can issue sweat equity only if it is in existence for more than 1 year. So that means if we are talking about a startup company which wanted to attract talents, it has to wait for 1 year, then only it can issue sweat equity for its employees. And because of that handicap, they may not be able to invite good talents into the company. Now they have proposing to delete that 1 year cap. That means a new company can also issue sweat equity to any of its members. Another areas where we normally worried about this particular act was acceptance of deposit rules. This acceptance of deposit rules has some prescription like deemed deposits, and some of the provisions of the deemed deposits make life miserable for small companies. So here what they have done is, first thing is, assuming that I am a company where I have taken an advance for supply of goods and I have not supplied the goods within 365 days of taking that deposit, taking that advance from my customer, automatically that is considered as a deemed deposit, and I have to comply with the requirements of the deposit acceptance rules. And you may be aware that if there is a non-compliance of the deposit acceptance rules, the minimum penalty starts with 1 crore and goes up to 10 crore, and also imprisonment up to 3 years time period. So this was a big issue for many of the companies, including smaller companies where they have the advance from customers. Now they have said that advance from customers which has been received in the ordinary course of the business will not be considered as deposit. Under the deposit acceptance rules, it will be exempted. It will be considered as a normal acceptance, irrespective of whether it's outstanding for more than 365 days. And another important point, some of the professionals who are sitting here and company officials who are sitting here, the moment the act has been introduced, one of the requirement was if you have accepted some deposits under the old act, which has permitted you to accept certain deposits, including unsecured loans, which we never considered as a deposit at all under the old act, those loans, the company has to make a declaration and that declaration should be filed with the Registrar of Companies. We call it as a DPT4, and that declaration says that what is the steps the company has taken to repay that loans within the next 1 year. So 1 year is 31/3/2015. Within that it should be over, and they have extended another 3 months, which is 2015 June. Now they have said that existing loans, if somebody wanted to regularize under the section 73 and 74 of the Companies Act 2013, now they have proposed to extend it for 3 years, which is actually helpful for many of the companies. And of course the liquidity ratio which has to be maintained, previously it was very huge. It is 20% on the current year maturing deposit as well as next year maturing deposit, on which 20% has to be maintained on a liquidity specific deposit. Now it has been reduced to 15% on what is going to mature in the next year. That is one point. And very interestingly, now they are permitting private limited companies also to accept deposits from its members. Previously what happens is, only if you are taking from directors, that is considered as an exempted deposit. But if you are taking from the members, there is a restriction which has been given. The restriction normally goes into the paid up capital and reserves of the company. In a small private limited company, it may be hardly 1 lakh or 2 lakh rupees, but the company may be running with the quasi-equity, which is normally unsecured loans from relatives of the members or loans from the members. Now they are saying that you can actually take loans from a member or a relative of the member without any limit. What is required is to pass a special resolution to accept that particular deposit. And interestingly, because the startup is one of the key agenda of the government, they have said startups can accept deposits from its members equivalent to 100% of the reserves, and for the next 5 years. So not necessarily in the first year, up to 5 years they can actually accept deposit. And the next important proposal comes under the CSR activity, corporate social responsibility. There is always a confusion with respect to how I will assess whether the CSR is applicable to me. The point was, it is based on the net worth, it is based on the net profit, it is based on the turnover. And the word which has been used, any year, any financial year. Any financial year means which year, whether current year or the previous year or year before that, or from the inception of the company, whether I have crossed that limit, was a confusion for many of the companies. Now they are proposing to clarify by saying that the words any financial year will be replaced by the immediately preceding financial year. So that means you have to only look at the previous year to see whether the turnover crossed the limit, or net worth crossed the limit, or the net profit crossed the limit, to get covered by section 135, which is talking about the corporate social responsibility. And similarly, there is the one anomaly which was there. What is the amount to be spent on CSR activity? 2% of the average net profits of the previous 3 years is what is prescribed. Now the average net profit has been replaced with the word net profit. As an accountant, I am trying to understand what is the difference between average net profit. If it is replaced with just net profit, I believe the percentage of amount to be spent by the companies will now become higher than when they are using the word average net profit. Because if I am taking a case of a company which is having losses in 1 year, in the 3 years, and the profits in 2 years, when I am making an average, the loss gets adjusted in the computation, and only on the balance you will be spending 2%. When I am using just net profit, the year in which I have losses, I will simply ignore it. So that's the way in which I assume that the situation will be. And interestingly, this is one question where we had repeated argument. Because this section comes with only one requirement. You spend, if you are not spending that, disclose that you have not spent that. But people always argue, if I have not spent the stipulated 2%, what I will do with the unspent money? Whether I have to carry forward to the next year, add it to the next year's 2%, and that is the cumulative number which I have to spend. Now the clarity which they are proposing in the rules is that it is no obligation to carry forward the unspent money. So it starts with spending, and if you are not spending, make a disclosure that ends in the particular year. Only in the next year you have to see again 2% of the profits of the previous years. Interestingly, they have also said in the rules, proposed rules, that is very good for some of the companies. For example, in 1 year my net profits is beyond 5 crores, and because of that I have to spend 2% on the CSR activity. And subsequent year, maybe because of the business is not doing well and my profits are coming down and it is less than 5 crore, and I am not get covered in normal sense by section 135 of the Companies Act 2013, still there was a question out of the old provision whether I should continue to spend on CSR activity even in the year where I am not meeting the threshold limit. Now they are saying that in the year in which you have not met the threshold limit, there is no requirement to spend on CSR, because every year there is an iron curtain and it is only looked as a separate year of this. On the auditor's side, it's an interesting amendment, and sometimes it creates some sort of practical issues with the companies. You see the provision, which is section 139 subsection 1 of the Companies Act 2013. That section says that an auditor will be appointed for a term of 5 years, and every year there will be a ratification of his appointment by the shareholders in the annual general meeting. Now what is proposed is to delete the requirement for ratification in the second year to the 5th year, and only on the 6th year whether the audit firm will be reappointed or not will be dependent on the company's shareholders to be decided. What happens in this scenario is an auditor who is appointed for one term will have the capability of continuing to be the auditor for next 5 years without any doubt of whether he will get reappointed or not. Very interesting but very simple process which they have adopted, but creating a lot of independence for the auditors. So I will share you, the moment you make a qualification in an audit opinion, sometimes some of the companies who are not having the taste of taking that qualification are immediately looking for changing the auditors, and we call it as an undue unjustified removal of auditors. There is a governance principle which is there in the CA Act. Now they are bringing that independence to the auditors by saying that no ratification is there, but there could be some practical issues which will come in. If the company really wanted to change the auditor because he is not really doing a good service, what they will be left with that? Actually, it is not prescribed here. That's the only question which is there. And if the auditor unwilling to continue within that 5-year period, even if he is saying that I am not seeking reappointment, it's considered as a resignation and he has to file the papers with the Registrar of Companies. Maybe central government approval is required if he wanted to remove the auditor before the expiry of that 5 years period. And for some of the chartered accountants who are here, we normally worried about the penalty and fine which is imposed in various sections when we are having this. And one of the problem was, in some cases it was even going to 25 lakhs. The audit fees which they might have charged only maybe 10,000 rupees or 25,000 rupees, but the penalty will be 25 lakhs. And maybe the 25 lakhs is the full year earnings of that particular chartered accountant also. But now they are having some mercy on the chartered accountants, and they are saying that the fine will be capped to 5 times of the remuneration or 8 times of the remuneration, depending upon whether it's unintentional or intentional default which has been made. Some thought process which has come in. And another important area where I can say that there is some good thought which went on to the amendment bill is to ease the related party transaction with respect to unlisted companies. Previously, the unlisted companies have been given some sort of relief, but they are trying to give more relief. For example, the audit committee has been given certain powers, and they are giving certain, the audit committee's approval is also not required if the transaction is between holding company and the wholly owned subsidiary company. That is also they have brought in. And interestingly, small companies, when we are advising, this is very, very important, which we worried always is that only 2 directors, 2 shareholders, husband and wife are running the company, and they wanted to pass a resolution for the remuneration of one of the director, who is the shareholder also. And we call it as an interested transaction. And how this resolution will be passed, we will go normally to the AGM and get it approved. And maybe because it's an interested resolution, we will actually pass it as a special resolution. But the provisions of the Companies Act said the interested party cannot participate in this voting. Now they are saying this rule will not be applicable if the number of shares are held, 95% or more of the number of shares are held by a director or shareholder who are related parties. So that means these small companies will get that biggest benefit on the related party transaction. The last important amendment which I wanted to touch upon is again, and welcome change, the section 185 of the Companies Act 2013. Loan to a company in which directors are interested. Normally a public company giving a loan to a private company in which directors are interested, it is prohibited under the old act. And under the new act also they have brought in that rule. But unfortunately in the drafting, even if a private company is giving a loan to a private company in which directors are interested, maybe I can give an example. Husband and wife of the directors in company A, and they are the directors in company B. They are able to mobilize funds in company A and they wanted to give loan to company B to run that operations. It is prohibited according to section 185 of the Companies Act 2013. Now what they are saying is they are bringing back what was the provision which was there in the old act. They say that it can be given, that type of loan can be given if a special resolution has been passed by the shareholders. That means only these 2 people, and we also said the related party transaction can be passed if it is more than 95% of the shares are held by the related parties. This section is not applicable. So that means interested party can also pass a resolution. So private companies are now have a breather for the funding purposes. But of course they have also said that only condition is it should be used for the purposes of the business, not for diversion. So this is one of the important amendment. And interestingly, the last point which I can touch is that they have said at the same time, you can give a loan to a company in which the director is interested or a person in which the director is interested, but not to a firm in which the director or his relative is a partner. That means diversion of funds has been stopped, but the genuine loan which has been given for the purposes of developing another company within the group has been now taken care. So I think that with the given time period, these are all the macro level analysis of the amendments which is proposed by this act. In my view, that this will create a very positive environment for the companies, and especially small and medium companies and unlisted companies without much of cost of compliance. And we are just waiting for the day on which this amendment gets passed and becomes an act. So, and thank you very much for giving this opportunity. Thank you.